Hello, my name is Elliot Gu. I'm editor of Personal Finance, the Energy Strategist, and I'm also co-editor of a service called MLP Profits, which focuses on the master limited partnership industry. I want to talk a little bit about that latter industry today. What we've been seeing in the last 3 or 4 months is actually MLPs, which are traditionally a very conservative, income-orientated group, have actually been among the best performers in my energy coverage universe. This is pretty unusual. However, I think there's very good reason and there's a very good fundamental underpinning for that. And that's basically that we've seen these companies' cost of capital really plummet here in recent months. What do I mean by cost of capital? Well, about a year and a half ago, at the height of the financial crisis, if a master limited partnership wanted to raise money, either by selling bonds, taking on a debt, a line of credit with a bank, or issuing new stock, or in this case units, basically issuing new shares of itself, they really couldn't do any of that. The stock market was weak, MLP prices were weak, therefore it doesn't make a whole lot of sense to sell additional units. The bank lending market was essentially totally closed. And really selling bonds, unless you were a AAA rated company, was next to impossible, and the rates you would pay would be prohibitive. The problem with that, of course, is that master limited partnerships, the way they grow, the way they increase their distributions over time, is really twofold. One, they raise capital and use that capital to fund acquisitions. In the MLP industry, acquisitions tend to be immediately accretive to cash flows, meaning that as soon as they make the acquisition, it raises their cash flow enough that they can actually boost distributions. The other way is to undertake what's called an organic growth project. That would be things like building a new pipeline. But the point is, either avenue of growth, you need money and you need to raise that money from somewhere. And typically, debt, equity markets were the way. That certainly wasn't the case about a year and a half ago. Nowadays, the situation could not be more different. Some of the large cap master limited partnerships in our coverage universe, in MLP Profits, which again I co-edit with Roger Conrad, are actually trading not far off all-time highs and certainly pretty close to 52-week highs. Therefore, coming out and doing a secondary offering of units really isn't that big of a deal. You can sell quite a few units at a very attractive price. It's a pretty cheap way to raise capital. Now, of course, when companies come out and issue new units, the immediate reaction is a bit of a sell-off. What Roger and I have found over the last year or so is that those prove to be great buying opportunities because the reality is those MLPs are not issuing that capital just for the fun of it. They're issuing those shares to raise capital to fund growth, which ultimately means higher yield for you. Now, what we've seen lately is a number of companies coming out with secondary offerings have actually come out and originally expected to sell a certain number of shares and then found demand was so strong that they were able to upsize that offering. Just a sign that institutional investors are just eating up these shares. The other side of the coin, of course, is the debt markets. Now, what we've seen lately, I think, is a very interesting trend, which is actually some MLPs that are not rated investment grade. They're below investment grade or high yield or what used to be called junk bonds. Actually going out there and issuing bonds and paying a very small spread over the U.S. Treasury. We saw one prominent MLP that we follow come out and issue about double what it originally intended to issue in terms of a debt offering. And the actual bonds are now currently yielding around 9%, a little bit under 9%. Now this is a sub-investment grade MLP, and really if you think about that, that's not all that much over treasuries compared to certainly what would have even been the case back in 2007. And this particular company is using that equity, or that debt rather, in combination with equity that it issued not long ago to make a series of large acquisitions. Now the acquisitions it's made just over the last month are actually more than it had planned to do in the entire ensuing 18 months. So it's actually seeing better opportunities to make acquisitions, better opportunities for growth, and better opportunities to raise capital than thought possible before. Now, what's the point of all this? Well, the point of all this is twofold. First, if you see any dip in one of our favorite MLPs or one of the better placed MLPs following either announcement of a new bond issue or a new issuing of units, this is a great time to get into that MLP. You'll get in at a little bit better price, and investors will bid that thing right up to new highs, as soon as it becomes clear that they're using that capital to fund growth, not just to pay off debt, whatever. The second thing is that I think we're going to see a major return to distribution growth this year. Very much absent in 2009, mainly because a lot of companies cut back on acquisitions and organic expansion projects because of the financial crisis and recession. This year, that's all coming soaring back because of all this capital they're raising. All that means is higher distributions for you and me, the unit holders. And I think that's something you're going to see kick in a big way towards the latter half of 2010. And I think that a lot of these things are going to get bid up as a result. The third catalyst, very quickly, is that taxes are going higher. There's still an open question whether dividend taxes are going from 15 to 20% or 15 up to whatever your full income tax rate is. The president's proposed the former, but if nothing happens, the latter will happen. MLPs are one way sort of around that. The tax laws governing MLPs will not change no matter what happens. And as a result, I think a lot of investors are looking at MLPs as a tax-advantaged investment in an era where taxes are likely to rise. So once more, better capital access spells good news for MLPs, and in many ways, so does their tax attraction. So thank you very much.